Hello traders, welcome back to Nova channel and let's continue another new topic today. False breakouts are one of the most frustrating and costly pitfalls in trading. In that moment, when the price appears to break through a key level, only for the market to quickly reverse, trapping traders who've entered with a false assumption that the breakout was genuine. But the truth is, false breakouts are more common than you might think. And if you don't know how to spot them, they can wipe out your gains or even lead to significant losses. First, let's find out what is a false breakout. A false breakout occurs when price pushes through a support, resistance, or trend line, but then fails to continue to the direction of the breakout. Instead, the price reverses and traps traders who enter the market, believing the breakout was genuine. These breakouts often happen in the choppy market conditions, during periods of low volatility or news-driven events when the price temporarily breaks a level, only to reverse sharply. Understanding how to identify a false breakout before it catches you in the wrong direction is critical. To avoid being a victim of a false breakout, watch for these key signals. The first, weak momentum after the breakout. After a breakout, price should show strong momentum in the direction of the move. If the price moves quickly in one direction, but then stalls, hesitates, or begins to reverse almost immediately, this is the red flag. Real breakouts have momentum. False breakouts often lack it. Second, if falls close outside the key levels. A genuine breakout usually closes beyond the support or resistance level, while a false breakout often closes inside or every near the key level. For example, if the price breaks above the resistance, but the close is only a few pips above it, this may indicate a false breakout. Wait for confirmation by seeing whether the price stays above or below the level after the breakout. It's related to volume divergence. In many cases, breakouts are accompanied by low or declining volume as suspects. Real breakouts tend to have increasing volume, signaling that traders are entering with conviction. On the other hand, a false breakout often has a weak or declined volume, indicating a lack of genuine participant in the move. Fourth, it also have rejection candles. Look for the candlestick patterns such as bean bars or engulfing candles forming after a breakout. They are strong indicators that price may be rejecting the breakout. A bean bar showing rejection of the breakout levels is an excellent signal to stay out or even take the opposite position. And lastly, is quick reversal. If the price breaks a level but quickly reverses and closes back inside the previous range, that's a strong sign of a false breakout. For instance, if the price breaks the trend line but immediately closes back inside, this is a signal of failure to sustain the breakout. One of the best ways to minimize the impact of a false breakout is to apply strong risk management principle. And here are the key strategies. First, you should use the tight stop losses. Only place a stop loss just beyond the breakout level. For example, if the price breaks resistance, set your stop just below the breakout point. If the price quickly reverses, your stop will trigger before your losses become too large. Tight stop loss are essential, especially in volatile markets where false breakouts are common. Second, risk a small percentage of your capital. Never risk more than 1 to 2% of your total capital on a single trade. And the third key point, don't over-leverage. Leverage can be a powerful tool, but it's also a double-edged sword. Like I usually remind you, over-leveraging during false breakout increases your risk of massive losses. Stick to low leverage and focus on high probability setup, not high leverage plays. And the next key point that you need to remember is trade with the trend. Trend following strategies are less likely to get caught in the false breakouts. If you're trading in the direction of a strong trend, it's more likely that breakouts are real. If the market is consolidating or in a range, false breakouts are more common. Avoid breaking out trades in range-bound markets and focus on breakout strategies when the trends are clear. And the last point you need to remember is taking a partial profit. A good risk management technique is to take partial profits when the price moves in your favor. This allows you to lock in profits while still keeping some of your position open in case the breakout turns out to be true. This allows you to lock in profits while still keeping some of your position open in case the breakout turns out to be true. And now I will share with you the tips. Do currency pairs and gold markets have more false breakouts? Both currency pairs and gold USD are frequently subject to false breakouts, but frequency depends on the market conditions. For currency pairs, the false breakouts can occur frequently in the currency markets, particularly during the periods of low volatility or when major central banks are about to release news. For example, a breakout during a range might look promising, but if it happens just before big economic report like non-farm payrolls or GDP data, it could reverse just as quickly. And for gold, on the other hand, is heavily affected by global risk sentiment and macro events, making false breakouts slightly more predictable during times of uncertainty. While gold can experience false breakouts, they are often more pronounced when the market is reacting to geopolitical tensions or sudden shifts in investor sentiment. Still, proper analysis of market context is essential before trading breakouts in gold. False breakout can be especially painful, and here are some pieces of advice to help you avoid falling into this trap. First one, you need to wait for confirmation. Don't enter a trade immediately after a breakout. Wait for confirmation, looking for a close beyond a breakout point or a price action signaling indicating a breakout is real. Second, don't overtrade. If you are new, don't feel the need to trade every breakout you see. Focus on high probability setup and remember, there will always be another trade, and you can refer the signal in the VIP signal group not to miss any opportunities to increase your winning rate. And the third method, you can use the demo accounts. Test your strategy in a demo account before committing real capital. This allows you to practice identifying false breakouts without the risk of losing money. And lastly, educate yourself continuously. Always keep learning, study the market structures, price action, and advanced risk management techniques. Knowledge is your best defense against false breakouts and any other market traps. In conclusion, false breakouts are an inevitable part of trading, but they don't have to destroy your account. By understanding the signs, managing your risk, and sticking to a proven trading strategy, you can minimizing your exposure to these traps. The key to success lies not in predicting every breakout, but in recognizing false signals early and managing risk wisely. Remember, in the world of trading, patience is power. Don't rush into breakouts. Wait for the price movement, trade with a plan, and always keep your risk under control. With practice and discipline, you will be able to spot false breakouts before they catch you off guard. And that is the topic today. Thank you so much for your watching, and don't forget to subscribe Nova channel to receive more useful video for your trading journey. Happy trading and see you in the next video.